Hi guys, today I would like to discuss with you fixed overheads. We did fixed overheads in class on Thursday, but I've had a bit of consultations on the subject, so I just want to clarify for those of you who didn't get it in class. Please note that you do not have to watch this video if you understand fixed costs. Now, we said that the first thing that is important when we are looking at fixed overheads is that they are treated differently for variable costing and for absorption costing. Right? We know that in variable costing, fixed costs are treated as a period cost, and under absorption costing, they treat it as a product cost. This means that then if they are treated as a product cost, they will have to be allocated to the product, which therefore means we'll have an allocation rate where we allocate our fixed cost to the product that we are producing. However, in variable costing, it is just a period cost. It is a cost that is incurred in the period and it is not allocated to the product that we are manufacturing. So when you do variances, I'll start with the variable costing. When you do variances, remember, in terms of variable costing, your variance can only arise from price. Because you do not allocate anything to the product, it is a period cost. So the only variance that you're going to have is a price variance, which we call an expenditure variance. And that variance is basically you saying, what did I budget to spend on fixed overheads and what was the actual spend on fixed overheads, and this will then be your variance. And we also said that so just to explain that again if you missed it, we said under variable costing we only have a price or expenditure variance. This means the only variance that arises is when there's a difference between what you budgeted to spend on fixed overheads and what you actually spend on fixed overheads, and then that will give you a variance which is either favorable or unfavorable. Just remember that when you do a standard costing question, you first need to identify whether you are using the variable costing method or the absorption costing method, because this then will tell you how you need to treat your fixed costs. Under variable costing, it is a period cost. Under absorption costing, it is a product cost, and therefore it's allocated to the product using an allocation rate. When it comes to standard costing, under variable costing, we only have an expenditure variance, which is the difference between your budgeted or fixed overheads and your actual fixed overheads. Now, I'm going to look at your absorption costing. So under absorption costing, we've already established that you allocate your fixed costs to your product using an allocation rate. We've established that you do have a price variance. However, what is additional? You also have a volume variance. This variance you do not have in variable costing method. So this is the main difference between how you treat your fixed costs in terms of standard costing. Under absorption costing, your price difference is the same as your absorption. So it would be the difference between what you budgeted to spend so the price variance, also known as the expenditure variance, will still be the difference between what you budgeted and what you actually spent for fixed costs. Now this is the same as what we had under variable absorption, under the variable costing method. So the only difference when you do the absorption costing method is the volume variance. Now we're going to discuss the volume variance. Just so that it's clear, we are doing absorption. This is the only method that will result in us having a volume variance for your fixed overhead costs. right? And for us to be able to determine what the volume variance, the first step is you need to determine what your allocation rate is. This is the rate that you use to allocate your fixed costs to your product. And we said in class that the allocation rate is your budgeted fixed costs divided by your activity. So this activity could be your production units, or it could be hours, which is then like your machine or labor. What you need to be, after you have identified that you're using the absorption costing system and you've calculated your allocation rate, which is the budgeted fixed cost divided by the activity, you need to see what drives the fixed cost, which is your activity here. It could either be that it's just production, or it could be that it's hours. Now I'm going to explain what it means when it's just production. If the question just says that this is your, like in the example that we first did in class, our production was what was given. We were not given hours. So we're not told that our fixed costs are driven by hours or that our fixed costs are driven by machine hours. We're just given the production. In that case, our budgeted fixed costs, we had said the allocation rate for that was just the budget fixed cost, and we divided that by the produced units. This is standard, remember, so that we can get an allocation rate. And then in terms of our variance, we then said what we produced. Okay, let's start with what we budgeted, budget production. From that, we subtracted the actual production. And we multiplied by the rate, which is this. Okay, so our volume variance was then the budgeted production, subtract what we actually produced, and we multiply that by the allocation rate. This was our volume variance, because the more we produce, the higher fixed costs we will have, because under the absorption costing method, we allocate our fixed costs to our production. So the more we produce, the more fixed costs we're going to have, and therefore you will have a volume variance as a result of that. And that volume variance, if the only thing you're given in terms of your fixed cost is just the production, then it means your volume variance arises because of production, which, like I said, just means you produced more, then you have more fixed costs. You produce less, you have less fixed costs. And this is how you calculate the variance. However, this is the last part. Remember, I'm still doing the volume variance. Do not get confused. I'm still doing the volume variance under the absorption costing method. Now, I tell you in the question, you need to be told that the fixed overheads are driven by machine hours or they're driven by labor hours. That means our volume variance can then be split into a efficiency and a capacity variance. Under efficiency, what you're basically saying is, in terms of the hours that drive our fixed cost, how many hours, so your actual hours, how many hours did you use in production versus your standard or budgeted hours? So if I'm doing efficiency, just like we do efficiency in labor, right? It is the difference between how many hours you spend in production versus the amount of hours you are supposed to spend in production for the unit that you produced. Now, remember, when we do fixed costs, we do an allocation rate. So at this point, once you've established that I'm going to take my actual hours, subtract my budgeted hours, I need to multiply by the allocation rate. Now, this allocation rate that you use just remember, you're working with hours. This is why I used an H here, to show you that you're working with hours. So your allocation rate also needs to be in hours, so that your final answer is correlating. So this is in hours, and then my allocation rate. If you've calculated your allocation rate based on the produced units, it means that you are multiplying units with the hours. But if you convert your allocation rate into hours, then you can get the correct allocation rate. I'll just remind you quickly. This is where what I just said comes from. When we calculate our allocation rate, it can be budgeted fixed cost divided by the budgeted activity, where we say the activity could either be production or hours. So in this case, it is hours. So your allocation rate, you calculate it normally, your budgeted fixed cost divided by the activity, but in this case, your activity will be hours. Now, let's talk about capacity quickly. Capacity is basically saying your budgeted hours versus your actual hours used. Now, your budgeted hours, not flexed. So you take your budgeted hours as it is given in the budget. You do not flex it for actual production. Remember, here you are already doing an efficiency variance. We're no longer doing an efficiency variance. We don't want to see how much time it took you to produce the actual units. We are looking at how much time did you budget to use, right? Versus the amount of time you actually used. Now, like I said in class, this is a potential variance. I'll give an example. If I used 1,000 hours actual in production, but I budgeted to use, let's say, 1,500. So if I use 1,000 hours actually, but I budgeted to use 1,500 hours, it means my capacity was unutilized. Therefore, it's an adverse variance. I didn't use the amount of time I had budgeted to use. I underused the capacity that I have. I didn't use my potential to the fullest, and therefore it's an adverse variance. However, if the actual was 1,500 and the budget was 1,000, I would have used more than I thought I had available, which means I went over and above what was expected of me, which means it is a favorable variance. I used my full potential. It means I would have to visit what I had budgeted for, because it can show that the people at the manufacturing plant can actually have more time available to them than I initially thought. Now, do not confuse the efficiency, because efficiency says, what did they use that time doing? Did they produce the amount of units that I expected them to produce? Capacity just says, how many hours did they have? How many hours did I budget that they will have? And the difference between that, the budgeted hours and the actual hours, gives me the variance. In this case, the difference between the hours I used in production and the hours I was supposed to use in production give me a variance. And for both cases, you use the allocation rate. So the first step when you're doing a fixed overhead volume variance is to re-establish what your allocation rate is, and then apply yourself in dividing it into an efficiency and a capacity variance. Last, like I said, guys, when we are looking at fixed cost, we've got an expenditure variance, which is the same as what we have under variable costing method. However, when we are using the absorption costing method, we've got an additional variance, which is called the volume variance. If our fixed costs are not driven by hours, they're just driven by production, then our activity will be simple. It will be that our volume variance will just be the difference between what we produced and what we budgeted to produce at the allocation rate. However, if they're driven by hours, Then you go further and you say efficiency. How effective were you? Did you use the hours available to you to produce the units that I had budgeted that you would produce, or did you not? And then I look at capacity. Did you use your budgeted hours to the full potential, or did you use less hours? Or if you use more hours, it means you went over and above, meaning that is a favorable variance, but do not confuse the two. With that said, I hope this video helps. Thank you very much and good luck with your studies.